Hello everyone and welcome back to Stock Navigators Option Series Chapter 3. In this video, we will talk about the Vega and the Implied Volatility, two very important factors that you need to understand when you trade options. So let's get into it. In the previous video, we briefly talked about the Greeks, which are the metrics to quantify the sensitivity of option prices to changes in the underlying market conditions. And we briefly go over the delta and the gamma definition in the previous video. And in today's videos, we will talk about the Vega. So what is Vega? Vega describes the sensitivity of an option's theoretical value to a 1% change in the implied volatility, or the IV, of the options. So long options will have positive Vega and the short options will have a negative Vega. The rising implied volatility will cause the premium of your option to rise, and the falling of the implied volatility will cause the premium of the option to fall. For example, if we trade NEO $51 call that has a premium of $2.42 per share, and the associated Vega of that option is 0.04, that means if the implied volatility of that option increased by 5%, then we can expect the cost of that option will increase by 5% times 0.04, which is the Vega equals $0.2 or 20 cents. So the new value of the NEO $51 call is now 2.42 plus 20 cents now equals $2.62 per share, or $262 per contract. And the Vega tends to be the highest for options that are at the money and will decrease as the option reach to its expiration date. So on the next chart, here is the example of how Vega value change with respect to the expiration date. So as you can tell, we have the purple curve represent the Vega value by 40 days before expiration. The green curve is 50 days before expiration, and the orange curve is the Vega value 60 days before expiration. And if you look at the bell curve at the middle, that is the Vega value when the option is at the money. So let's look at one example with Tesla options. On top, if you look at the option expired this Friday, December 10th, 2021, and compare against the option expires 4 weeks from now, which is the end of December 31st, 2021. If you look at the same strike price of these two options at $1,010 strike price, you can tell that the Vega of the call options expired this week will be much lower than the Vega of the option expire on December 31st. So let's talk about the implied volatility. Why we talk about implied volatility? Because the implied volatility and the Vega will go side by side and they will affect the premium of your option. So let's say if for some reason the implied volatility in the market start increase, that means that will affect the premium of the option that you were trading as well. So by definition, the implied volatility reflects the consensus opinion of options market participants about how volatile the underlying stock will be through expiration. The high or the low implied volatility means that the market participants are expecting a high or a low volatility in the price of the underlying stock, maybe due to the news. Good news or bad news may affect the stock price movement, or earnings, good earning or bad earnings that may cause a huge volatility in the option price and the stock price as well. Or sometimes on certain day when we have the Fed talk, that will cause some volatility in the market as well. So the implied volatility is constantly changing as new information will influence the market, and that will alter the expectation of the participants. So, in general, a high implied volatility market means the market participants see risk in the price of the underlying stock, and the premiums of that associated stock will be increased to reflect this risk, and the rate of return might be higher than normal to reflect the risk as well. And the opposite, when you see a low implied volatility, means market participant will see a low risk of the underlying stock, and the premium of the option will be decreased to reflect the lack of this risk as well. And also the rate of return may be lower than normal to reflect the lack of the risk. So, for example, I have the VIX index here from the Chicago Board of Exchange, which is a very important factor when you day trade or you trade options in general. So the VIX is sort of an inverse of the market. Whenever you see some significant event happen in the market, that would tend to push the VIX index up. For example, if we look at the left here, the tip of the chart, that was the 2020 COVID crash, when the whole country and in general, everywhere in the world was shut down, and there was no trading, no activities at all, and everybody started selling off their position to either to protect to take the cash back or to preserve their capital, and that would cause the VIX index to shoot off the roof. And same thing in the past couple of weeks, we heard about the Omicron variant news, and again, the fear start kicking into the market, and people start selling off their position as well. As you can tell, VIX start slowly going up in the last couple of days, and as a rule of thumb, whenever VIX is below 20, we have a very calm, very bullish market. But when VIX start going up above 20, that's when you will see some maybe either minor or a major correction, and there will be a lot of selling in the market. So let's talk about how earnings affect the implied volatility. On this example, I will look at the ticker COUP, which is Coupa Software Incorporation. They have earning today on December 6th, 2021. And we're looking at two different expiration dates here. The first one is on December 10th, which is this Friday. And as you can tell, in the parentheses, we have the expected move, which is the range where people think the stock might potentially move to plus or minus $32.51. And the implied volatility associated with this expiration date options are almost 200%. But when you compare this against the option expire at the end of this month, which is 4 weeks from now on December 31st, the expected move for this expiration date is actually more than the one on December 10th, which makes sense because as you give the option more time to expiration, it will have more time to move to either a higher or a lower price. Whether with the short-term options, the time is limited, and therefore the stock doesn't have a lot of time to move to the wider range as compared to the long-term options. However, the implied volatility for the option expire on December 31st is only 92%, which is half of the option expire on December 10th because of the earning. So the earning week or the earning day actually affect the implied volatility of the option a lot. And when you look at, let's say, the strike price at $175, the option expired this week has the implied volatility of 189%, which is double the implied volatility of the option same strike price expired in December 31st, which is at 92%. And therefore, because of the increase in the implied volatility, when you multiply that with the Vega, that will push up the price of your premium as well. So meaning when you buy option, either buy calls or buy puts before earning or during earning, you are essentially buying an overpriced options. So that is a very important thing you need to keep in mind when you want to trade options around earning, because what you might experience the day after earning is what people call the IV crush, or the implied volatility crush, due to the drop in the IV after earning. Let's say you bought overpriced option the day before earning, and then after earning the implied volatility drop and the premium of your option drop as well. So that result in immediate loss, even regardless of if the stock price go up or go down, you are already in a loss because of the IV crush. Hope that makes sense. So this is the end of this video. If you like what we do here, please give us a like, a subscribe, and we will notify you when we have new videos. Thank you for watching.